guys, Brian Stevens here with Mortgage Shots. Now, here's a crazy fact. According to NerdWallet, only 28% of Americans who wanted to buy a home in 2024 actually did. And of those, just 24% of home purchases last year were first-time homebuyers, the smallest share since the National Association of Realtors began tracking this data back in 1981. Now, why is this? Well, it's the same reason as always. Affordability, where prices have gone up 33% since 2020. Rates, obviously, which has doubled over the past 3 years. And frighteningly, what's not being considered, but will this year, is going to be insurance premiums, which are going to go through the roof, which is always a perfect segue into the next and obvious story. LA is burning down yet once again, and the Santa Ana winds ain't offering any relief whatsoever. Now, I know I'm not painting a pretty picture. I concede that point. But what you should be asking yourself right now is, what can you do about it? Well, there's a whole bunch of stuff you can do. For example, you need to look into the one-time close program where you can do 97% or 100% financing with FHA and VA deals with land acquisition, and where you can put manufactured and modular homes. Oh, and even those, what do they call them? Barn dominiums on those lots, all with FHA and VA loans. Now, the programs follow standard guidelines, but better. You can actually finance your closing costs. Did you know that? There's no payment due during the construction phase. No requalifying after the construction is done. You're just done. And like I said, now you can do barn dominiums, which are all the rage. I can't begin to tell you all the good stuff that will happen to your business if you go down this path. Well, hold on. Actually, I can. I just did a webinar yesterday. You can check it out down below for more details, and you can contact me if you want to, because my contact information is in the presentation, so you gotta watch it. Next, and I keep saying this, but hear me out here, guys, gals, non-QM. Fact, your average self-employed person makes about twice as much money as your average W-2 employee, and last time I checked, it really helps with the problem of affordability if you make more money. Fact. With non-QM, you could mix and match incomes. You could do 12 or 24 months bank statements, depending on what's going to best benefit your client. You can use straight up 85% of the income on your 1099s, and we have more gig workers now than ever. And by the way, talk to my friends at Oak Tree about this stuff. You can get them down below. They'll help you out. You could have a client who's only been 1099 for 2 months if he's got 2 years history with the same company or the same line of work. Asset depletion is crazy cool, but here's the thing. You can mix and match your bank statements with asset depletion, with your 1099, if your case allows for it, in order to extrapolate more income. Yes, and we need more income, right, for these expensive homes on your borrowers. More income than if you just stick with your typical Fannie, Freddie, Ginnie agency loans. Right? Listen, and these are solutions to the problem I just set up for you. Meaning with non-QM, more borrowers and more income could all be on the table for you. I mean, you might be able to qualify your competition's turndowns because they weren't looking at all the financial options that were on the table. Guys, this is a very simple case. The loan officer who knows more and grinds it out is going to win the game. And the game is harder than it used to be because this is the market that we're in. Now, these are just a couple of examples of what you can do for a market that is shifting. How are you going to pivot? I just gave you a couple of solutions. Now, there's no easy road to victory. You have to understand, this ain't 2020 anymore where there's easy loans, and you ain't in Kansas. I guess unless you're in Kansas. I hope this helps.